Today, we will talk about the concept of contrarian investing. Contrarian investing is an investment style in which investors purposefully go against prevailing market trends by selling when others are buying and buying when most investors are selling. Berkshire Hathaway Chair and Chief Executive Officer Warren Buffett is a famous contrarian investor. Contrarian investors believe that people who say the market is going up do so only when they are fully invested and have no further purchasing power. At this point, the market is at a peak. So, when people predict a downturn, they have already sold out, and the market can only go up at this point. Contrarian investing is, as the name implies, a strategy that involves going against the grain of investor sentiment at a given time. A contrarian investor enters the market when others are feeling negative about it. The contrarian believes the value of the market or stock is below its intrinsic value and thus represents an opportunity. According to David Dreman, contrarian investor and author of Contrarian Investment Strategies, The Next Generation, investors overreact to news developments and overprice hot stocks and underestimate the earnings of distressed stocks. This overreaction results in limited upward price movement and steep falls for stocks that are hot, and leaves room for the contrarian investor to choose underpriced stocks. Contrarian investors often target distressed stocks and then sell them once the share price has recovered, and other investors begin targeting the company as well. However, this sentiment can lead to missing out on gains if broad bullish sentiment in the markets proves true, leading to market gains even as contrarians have already sold their positions. Similarly, an undervalued stock targeted by contrarians as an investment opportunity may remain undervalued if the market sentiment remains bearish. Contrarian investing is similar to value investing because both value and contrarian investors look for stocks whose share price is lower than the intrinsic value of the company. Many value investors hold that there is a fine line between value investing and contrarian investing, since both strategies look for undervalued securities to turn a profit based on their reading of the current market sentiment. The most prominent example of a contrarian investor is Warren Buffett. Michael Burry, a California-based neurologist turned hedge fund owner, is another example of a contrarian investor. Through his research in 2005, Burry determined that the subprime market was mispriced and overheated. His story was written up into a book, The Big Short, by Michael Lewis, and has been made into a movie of the same name. Investors interested in employing a contrarian investing strategy should be aware of some of the strategy's drawbacks. It can be challenging to find undervalued stocks, and contrarians typically spend a great deal of time researching stocks and various industries to find potential investment opportunities. It will not be enough to rely on simply doing the opposite of the prevailing market sentiment. Contrarians may have periods where their portfolios underperform, and it may take a significant amount of time before an undervalued stock begins to show gains. Here are 3 key takeaways. 1. Contrarian investing involves going against existing market trends to generate profits. 2. Markets are subject to herding behavior augmented by fear and greed, making them periodically over and underpriced. 3. Being a contrarian can be rewarding but is often a risky strategy that may take a long period of time to pay off. Hope this would help. Thanks for watching.